Welcome back to the Central Kentucky Ag Credit Basics of Borrowing class. My name is Joe Goggin. I'm a loan officer with Central Kentucky Ag Credit, and I'm joined
Willie Wilson, also loan officer with Ag Credit here in Lexington.
Quick recap. Last week we went over, of course in this whole series we're going over the 5 C's of credit, and last week we covered capital, which what we were talking about with capital would be your financial position, assets and liabilities, and then we also discussed how that ties in with what we covered the week before of capacity, where we talk about change in your net worth, needing to somewhat mimic your bottom line on your earnings of your capacity. And today we're actually going to cover 2 of the remaining C's, collateral and conditions. Willie, you want to start with collateral?
Yeah, first we're going to start talking about collateral, specifically what collateral is and why lenders require collateral. Collateral is an asset that a borrower pledges to the lender as security for the loan. So in other words, if the loan were to default, this would be what would be liquidated to pay the lender back. So lenders require collateral to offset risk. It's another risk management technique that's used to ensure that they are protected. And that's basically, I mean, I don't know of any other way to describe collateral.
Right, and there's different types of collateral that a lender will ask for. The 2 main types are, of course, real estate. If you're getting a real estate loan specifically, you'll have to have real estate for collateral. The other type is chattels, and that's a term that you'll hear, but a lot of people don't know what we're talking about when we say chattels. And basically chattels covers anything that's like equipment or vehicles or livestock or even crops. Inventories. That's chattel collateral. So if you hear that word, that's what lenders are talking about. And with chattels, you're limited on the length of the loan that you can go. Those are going to secure loans that are more short-term or intermediate term, 3 to 5 year type loans.
Right, exactly. You can't use chattels to secure long-term loans. So if you're going to buy a farm, you wouldn't want to put a tractor up for collateral.
Right.
To secure that real estate loan.
But the other way, if you're buying a tractor, and if you wanted to, you could use real estate to secure that. So really, real estate will go to secure not only long-term loans, but you can use it to secure short and intermediate-term loans. And a lot of times, borrowers will choose to do that.
Right.
It's just simpler. A lender can take a mortgage on a piece of property and loan against that mortgage, and they don't have to have a lien on their equipment or their cattle if they've got enough equity in the real estate to secure that debt.
Flexibility to the
You
borrower.
do have a lot of flexibility, exactly. But it does go back to the type of collateral will determine the length of that loan.
That's right.
Where you are limited with chattel collateral. If all you have for collateral is cattle and equipment, then you're going to be limited to how long a term you can put on that loan. And typically it's going to be 3 to 5 years.
And the reason for that is a lender doesn't want to have a loan that the term outmatches the life of the collateral. So if you're looking for a 10-year loan, you wouldn't want to have a group of cows pledged for that collateral, because the question is, well, where will the cows be in 10 years?
Right.
Probably not around to
And if you're getting a loan on cows, you don't want to term that out for 10 years because you don't want to be paying for those cows for 10 years because they're useful life. Even though you're probably going to be retaining some heifers or doing something to keep your cow herd younger, you still don't want to be paying for a group of cows for 10 years on it. Willie, I know something we see a lot of times. We'll have a lien on a borrower's equipment. And let's say there's a 2955 John Deere that they own. And we've got a lien on that tractor, but then they go to a dealership and they trade that tractor in.
Right.
And you might talk about that. What about trading that in and getting something else?
Exactly. So if you, just for instance, if you had a cow note here and you didn't want to put money down on the cows, but you wanted to pledge a tractor for additional collateral, so you didn't have money down on the cows. But then a couple years down the road, you say, oh, it's time for a new tractor, and you go down to the Deere dealership and you trade it in and you finance the new tractor.
Exactly.
So now the tractor you use to pledge for your cow note is gone, and the new tractor has a lien on it, presumably with John Deere or any other creditor that you got the loan through to buy the new tractor, and all of a sudden you've sold collateral
Right.
that stood for a loan that you still have.
And then when that lender checks and they say, wait a minute, we don't have as much collateral now because you traded the tractor that we had a lien on. And so we see that occasionally. We try to always caution borrowers, if you've got a lien on a piece of equipment or a blanket lien on equipment, you need to be very cautious about taking any of that and trading it in and potentially financing the new piece with another dealer or another lender on that, because then that lender's collateral has disappeared at that point.
And that's not prevalent, but it's most likely to happen with equipment, livestock, things like that. Whereas real estate, there's what's called a mortgage on the real estate that's publicly recorded. The property can't be transferred or sold without that mortgage being released. So, and that's another reason lenders are willing to go longer terms on real estate, because there's a little more concreteness to the way they're secured.
Right. Another issue with chattel collateral is where you have loans with one lender and you pledge maybe all cattle or all equipment. Then you go to another lender and you get a loan and you give them a lien on that same, another lien on cattle. Then you've got two lenders using the same collateral, which really is not a good situation for anybody.
Another thing too, when you've got feeder cattle securing your line of credit for the calves you bought, or you've got an operating line of credit and you've got the crop standing as the collateral, when those calves are sold or when that crop's taken to the elevator, the money needs to be paid back down the line of credit. So at all times, your credit balance should match your inventory balance to a certain ratio that's determined by you and your lender. That's another example of when an asset's sold, it needs to be applied to the
Exactly, because a lender expects you, if they have a lien on your feeder cattle and they're using that as collateral against your feeder cattle note, they expect you to sell those feeders, but once they're gone, that money has to be applied in, because now that lender doesn't have, the collateral's gone, so the loan has to also correspondingly, pay down and be gone. So
I guess that's a good intro into how do we value collateral.
Exactly.
So for real estate purposes, generally speaking, we have an appraisal done, which means we're going to hire a certified appraiser who's going to go out and do the research and tell us what that particular piece of real estate's worth at that particular time.
Right.
And appraisals are very important for determining the value of real estate collateral.
Right.
If you've got any
Now,
comments.
and that's why we will only use, as far as I credit, certified appraisers. They have to be certified real estate appraisers, approved and on our list to somebody that we know the quality of their work and the value of their work is going to be accurate.
They know our expectations.
And they know our expectations as well, exactly. But when you get into equipment and cattle, we also have to come up with a value on those. And so we'll use different methods. Livestock, a good way is to use market reports, sale barn reports, or other sale reports that we have access to. Equipment, we've got different ways. Machine repeat, tractor house. There's several different ways. Local auctions, maybe. There's been some auctions that have sold some equipment that we can have similar types of equipment that we can get an idea from an auction setting what the value of those is.
And I think an important thing to note there too is because if you bought a tractor 2 years ago for $10,000 doesn't mean that today it's worth $10,000.
Exactly.
So if the transaction's a little stale and like you said you bought 2 years ago, we need to go out and find out today. Maybe it's still worth $10,000, maybe it's worth 11. Whatever it is, we have to have some sort of verification on the value of the asset. Auction data is typically the most desirable.
What one thing I don't think we've covered, what percentage we loan of our collateral?
So yeah, that depends. It goes back to the other C's of the credit. If we've got some strength in other areas, we might be able to go a little higher on the percentage on collateral, or weaknesses have to go lower.
Right.
So for real estate, if we've got a monthly pay real estate loan, we'll loan 80%. What the term we use is called loan to value. LTV is the acronym. So that means if the farm was worth $100,000, we can loan up to $80,000 on a monthly pay real estate note.
And on an annual pay, we generally back that down to 75%. And the reason is, with the monthly pay, you're getting interest paid every month, current. Well, with an annual payment loan, you're going a full year. So by the time you get that interest added on to the principal balance, you're at an 80% loan. And so that's why we loan up to 75%.
And if it's cattle, only the cattle that are being purchased or pledged, it's 50%. You buy one, we buy one. But if you've got other assets that can be pledged, it's not always about the down payment.
Right.
So that also applies to real estate. You know, sometimes we have people that maybe already own a piece of real estate, want to buy their second, they can pledge that first piece of real estate for additional collateral versus having to put money down on the second one.
Yeah. You mentioned appraisals a minute ago. When we talk about if somebody has a tract of land, it's just a bare land tract, and they have it for collateral against the loan, and now they come back and they want to build, say, a $30,000 barn.
Mm-hmm.
The effect of that, adding that barn, or even adding a house on that,
Yeah, so
what it has to the appraisal.
those can be difficult situations sometimes, because if someone just bought the farm, they're ready to do some fencing and install some water lines, they might not have a lot of equity in the property, but the improvements they're making don't add a dollar for dollar value. So if you spend $10,000 on fencing, your farm's not worth $10,000 more now.
Right.
So there are some improvements. A barn might go a little further, you know, than say fencing would. So we have to get another appraisal done, or if you know you're going to do it when you're buying the farm, we can get one done at that time. What's called an as will be completed appraisal. So that way we know when you put the fence on it, when you build the barn, when you build the house, whatever it is, improvement you're making, we know what the property's worth after the fact.
So the bottom line is really an appraisal on a piece of property is that's the value that if you were to sell that piece of property, what you could, on a fair market value, expect to receive for it. That's really, and so if you have that $100,000 piece of land and you build a $50,000 barn, somebody's not likely to pay $150,000
That's right.
for that tract of land now just because that barn is now sitting on it. They may pay 120 or 125 maybe on it, but they're not likely to pay the 150. And that's why when you add improvements to a farm or a tract of land, it doesn't add, like you said, dollar for dollar on it.
And that's something just really important to keep in mind. That's not something most people consider.
Right, right. So, do you have anything else? You want to move to conditions, or
unless anybody has any
else?
questions about collateral, you can send them in. I know.
Oh yeah, we need to.
We posted a while ago, and we're still doing that. If anybody would like to ask any questions, we've got some giveaways. We're going to send those people. So ask away, give us your hard questions, and we'll see if we can get them answered.
Yeah, yeah.
And if not,
if it's a hard question, I'm gonna let Willie answer it. If it's an easy one, I'll take the softballs.
Okay. So we'll move on to conditions, which is the last C we'll cover in this series.
Right. Conditions. When we talk about conditions, we're basically talking about the terms of the loan. Is it going to be a 5-year note with monthly pay, or a 4-year loan with annual payments? There's several things that we do think about when we talk about conditions, but that's the first one's a term, the frequency of payments. So,
you know, one thing we always try to do is have our repayment conditions specific to each borrower. So if we've got someone that's a full-time farmer that only gets income once a year, you know, we don't want to give that farmer a monthly payment.
Right.
We want the payment frequency to match his income frequency. So the same thing for cows. You know, if you come in and you borrow money to buy cows, and you're going to have split spring and fall calves, you probably need a semi-annual payment.
Right.
So that's, in my opinion, one of the biggest factors to consider when looking at conditions, is that we've got reasonable expectations for the borrower, so that way they're happy and we're happy too.
Exactly. Try to match that payment schedule to their income schedule.
And if someone's got a monthly paycheck, you know, and they're buying real estate, the monthly payment works best for that person.
We'll see where most of the income comes from a salary job, and so it works well to put it on monthly payments. Another portion of conditions is the market conditions. If we're talking about a cattle loan, then we're looking at, you know, what's the conditions in the cattle market. Right now, we all know, you know, cattle, grain, doesn't matter what we're talking about right now, it's pretty tough.
Right.
But we've got to take that into consideration, and really in times like these, look at it more on a typical year.
Right.
Because nobody really knows right now with the whole, you know, situation we're under, what the markets are likely to do. So we look at it from an historical standpoint of a typical year, typical markets, what can be expected on that.
Yeah.
You want to talk insurance?
Yeah, so a lot of times the condition of a loan would be that we've got insurance on the collateral.
Right.
Or also insurance on the borrowers. So those are two different insurance policies, and again, it's, you know, we're not insurance agents, but you know, we like our borrowers that work closely with their insurance agent. So if you're going to buy a truck, you know, you're going to pledge a truck for collateral, you got to have insurance on it. You got to have insurance on your truck anyways.
Exactly.
But tractor, the same thing there, because, you know, fires happen. You don't. Last thing anybody wants is to have a tractor burn up that they just bought and have a loan on it still, and the tractor's
Right.
gone.
Right.
So, insurance is going to be one of those important parts of conditions, and livestock as well. You can get insurance policies on just about any sort of asset these days.
Right. And we're not saying, how much insurance. I mean, you obviously, a lot of people will get it to be just an amount to cover the note. Well, you really got to think about that as if you have a tractor and you have something happen, a fire or something like that, or a combine. Do you really want your insurance to be limited just to paying that note off, or do you
Right.
want to be covered for the value of that piece of equipment?
Would you rather be able to replace it?
Exactly, replacement cost on that.
Right. And the same goes for a house.
Exactly. Yes.
I think house fires are certainly not fun to think about, but would you rather just be able to pay your loan off? Would you rather be able to rebuild your house?
Right.
So, those are certain conversations you'd have to have with your insurance agent
Right.
for sure.
Another thing we talk about and take into consideration on conditions are loan covenants. Sometimes if it's a feeder calf note or revolving line of credit, we'll put in that we'll come and do a farm visit annually, or depending on the size of the loan, the borrower we may say update your financial statement at least annually, which goes back to our discussion last week on capital. Doing those financial statements at year end is an excellent time to do that, and then you have it done to provide your lender if they need an annual updated financial statement,
Right.
which would be potentially one of the conditions of your loan.
Inventory balances, could be periodically requested to make sure that you've got the grain inventories of the cattle on hand to offset your line of credit balance. So
Right.
that might be an annual or semi-annual or quarterly. It varies per operation.
Right.
We had a question come in.
Okay.
What are current interest rates on buying property?
And since that's a harder one, I'm gonna let you.
So interest rates are historically low right now. That said, it really depends on several factors. So it's
It really
not
goes
like
back to all
Right.
of the 5 C's.
it's not like buying gas. You don't drive down the road and see that gas is $1.50
Exactly.
a gallon. So we'd like to work with the person and see, first
It
of all, what
depends
type of
on the
property they're
term.
buying, how long of a loan are they looking
How
for.
long a loan?
Exactly.
Yes. How long do they want a fixed rate? There's a lot of factors that go into determining an interest rate. One thing that, as a general rule to keep in mind, a short-term loan will have a lower interest rate than long-term. As you step up the length of a loan from maybe a 5-year note to buy a new tractor versus a 20-year note to buy a piece of real estate,
Right.
the length of that loan, the length of the fixed period, will generally step up in interest rate.
Right. And even within that subset, you can have a 20-year loan, but maybe the rate's only going to be fixed for 5 years of the 20.
Exactly.
And that would be a lower interest rate than a fully
Yeah.
fixed 20-year loan. So,
So really it does depend
Right.
on a lot of factors. And as Willie said, right now it's a good time to borrow money, quite honestly, because of the historically low interest rate environment that we're in.
Or we have another question. Would you rather see someone with more collateral or more cash on hand?
As in cash on hand, I'm assuming they mean to pay down on that. And really, I hate to be a little vague here, but it does depend on the situation. I mean, you can have additional collateral. You can achieve the same end result, the same goal in both situations.
right.
I guess
And I
that's
think
what
it's
I'm
about
trying to
a
say.
right balance too.
Yes.
If you've got $20,000 in the bank, but you can't put, you don't have any assets to pledge for collateral, well, that's not good, and vice versa is not good either.
I guess I would rather have. I don't want to take somebody if they've got a lot of cash on
They make
hand,
down payment.
as in a down payment. You don't want. You've got to think down the road. So in this situation, I'm assuming you're talking about buying a piece of property and potentially having a fair amount of cash on hand for that down payment. But then after you buy the property, what are you planning to do? Are you going to have expenses for improvements that you plan to do? Are you going to want to put in water lines and drinkers? Are you going to want a fence and potentially build something that maybe you would use that cash for? Where in that situation, if you had additional collateral, you could use the additional collateral, get the property purchased, and use your cash for smaller expenses such as improvements that you plan to do. Maybe put a road in or upgrade grade an existing road.
Right.
So really, it depends on the situation and what your goal is after you purchase the property, I think.
You can't go wrong with having cash though.
Exactly. You know, and I will say, quite honestly, I mean, having a large amount of cash on hand to potentially use as a down payment from a lender's side, I mean, that looks good.
Mm-hmm.
I mean, it shows back to the first C that we talked about, character and management ability. It shows that borrower's management ability to be able to save and put cash back for a situation where they plan to purchase a piece of real estate. So again, it shows how all of the C's tend to tie together here.
Yeah, and I think on a wrap-up point, unless we've got any other questions, or if there's questions not answered. Okay. I think it's important to know that all the C's are connected.
Yes.
You can't only focus on one, and the lender doesn't only focus on one. And certainly, the larger the request and the more complicated the situation becomes, they all become equally important.
Right.
So,
Right.
and some people get hung up on cash flow, but they don't pay attention to their balance sheet, and you can't do that. Or you can't ignore one without paying the price.
They are all connected, and lenders look at all of them, just like the cash question. You know, it pertains to character. It also pertains to collateral, how it affects potentially the collateral. And obviously, if you're taking a balance sheet on that person that asked the question, then you know they've got cash and current assets up here, so it affects the capital C as well. So another thing on wrap up, you know, we've talked about now all 5 C's of credit: character, conditions, capital, capacity, and collateral, and how they're all connected and equally important, as Willie said. And you know, we're in the business of making loans, but also sometimes one of our most important jobs is when we have an applicant come in and we analyze the 5 C's of credit and we look at that full package, and maybe that request just doesn't work at that time for some reason. Our most important job sometimes is simply telling that applicant we cannot do this loan.
Right.
But it's also, as a potential borrower, you've got to realize it's also very important to ask questions. Ask your lender, you know, to explain why, because there may be some place that you may be strong in some areas, but maybe need to work on something else. And so sometimes it could be that. Sometimes a request is just simply unreasonable. There's various reasons. But as a lender, we want to make sure that we are not putting a potential borrower in a position that can be detrimental to them. And that's a big part of our job, is to analyze that and make sure that this credit is good not only for us as a lender, but for the borrower as well.
It's not always just no. A lot of times it's not right now. You know, maybe you need to focus on increasing your net worth. You know, especially if someone just getting started out wants to go out and immediately buy a farm. Oftentimes they don't have the net worth or the owner's equity position to do that. So
or the additional collateral
in a couple
cash.
of years,
Yes.
Things have improved, and you know we'd like to talk to them at that time. Or they need to focus on their historical earnings and show what they're doing is not just a 1-year anomaly. If they can give us a couple or 3 years of that, that might make the lender more comfortable. So I think that's the important thing. You know, obviously, it's never a fun situation for either side, but to stay optimistic and where can I improve, and ask the questions of why.
And hopefully your lender will work with you and explain, so you as a borrower will understand, and then can improve in areas that you need to improve in to help you down the road. So with that, I mean,
that concludes.
Unless anybody has any other questions, we've enjoyed doing these series. Hopefully they've been helpful. Hopefully you as a viewer will take something away from these. Invite you to go back and look at the previous 3 weeks and watch them. And we would certainly welcome any suggestions if you have for potential future video series that we can do.
And if there are any questions you think of later, feel free to send them in. We'll be glad to answer them and get any information that's requested out to whoever needs it. All right.
Thank you.
Thanks for watching.